Fiscal risk back in the spotlight for the bond market. Jeff Sherman of DoubleLine saying this: we are neutral on intermediate treasuries. The market is focusing on the fiscal side, which could drive rates higher over the short term, given the one big, beautiful bill. Jeff's here in New York. Jeff, good morning. Good to see you.
Morning.
Lisa and your colleague made the headlines in the last week or so. A reckoning is coming for the US debt market. So just refresh our minds, our memories. What is the stance of you and the team at the moment on the Treasury market?
Well, the Treasury market has a lot of risk in it today, and we're seeing this from all the fiscal uncertainties that we see out there. We're debating whether the policies will indeed be stimulative. But at the end of the day, we all know that it's really bad for the deficit. And, no matter how one looks at it, slapping on an additional $2 trillion over, what is the time frame? Is it over a couple of years? Is it a decade? We all have to argue what the benefits are as well. So what you've seen, even like when I look at when the markets opened, with all the conflict we had over the weekend, actually treasuries were off once again, right? The yields were up. They were selling in treasuries to begin kind of that trading session, even though oil was spiking at that time. And so is it the inflationary impulse, or is it the lack of flight to quality once again? And so this has been on investors' minds really for the last couple of years, is that, there is a day of reckoning one day when it comes to the treasury market. Is it June of 2025? It's not likely. Luckily, we only got one more week left, right? It's probably not July either, but this is just not tenable over the long run. And so the challenge is you have, the president, with Jay Powell's testimony today saying Jay needs to lower 2 or 3 points on rates practically overnight to really help them continue to spend. But maybe the answer really is, and this is where we shake on it, maybe they don't need to spend. Right? Maybe they need some pain from the bond market to say it will be punitive that if we continue to follow these policies. So tax cuts sound great, SALT sounds great, all these things sound great to wealthy investors. But at the end of the day, we are mortgaging the future.
Just to build on that point of what Jerome Powell is going to be facing off with in Congress, President Trump has gone after him again and again, talking about lowering interest rates to make U.S.'s borrowing costs go down. How much does that affect your calculus as well, especially as you have two Fed governors saying, yeah, as soon as July, we could see rate cuts? Yeah,
we saw Bowman come out yesterday with those comments as well. But look, it's not this democracy at the Fed. Typically, what you have is the chairpersons in charge trying to coalesce, gather, kind of sentiment. It's not like in the UK where there's lots of dissension and, you get 5-4 votes. I mean, there tends to be this unanimity across, when the policies come through. And so I'll give Jay kudos that he went from being Bonehead Jay, just too late now is the nickname that he's getting today.
Is that graduated?
Yeah, I don't know. Too late sounds better than Bonehead, I think. I think Jay Powell's a pretty smart man. But look, at the end of the day, he's told you his positioning. I don't think that changes in front of Congress right now. And the fact that, what was it? I don't even remember the quote this morning that President Trump said, but it was like that they need to, go after and attack Jay Powell. It's not going to change the stance. It's not going to change monetary policy, as they're still worried about the inflationary effects of the tariffs. And so, this multipolarity world we have and all the variables going on, it's just not as simple as lowering rates, because at the end of the day, you lower rates, you condone the behavior of our elected officials, you condone the deficits, and effectively it could lead to an inflationary impulse on the other side.
Yeah, there are these sort of dueling risks. We've been talking about this all morning, inflation versus growth fears. Yep. And if the Fed were to cut rates, that could do some damage to inflation expectations to the upside. This could necessarily prolong, though, also the growth cycle. Given the fact that your colleague Jeffrey Gundlach came out and said that credit really looks incredibly risky in terms of the valuations and what you're getting compensated for, if the Fed were to ease policy, would that improve the credit outlook, or would it make it more vulnerable?
Well, no, I mean, it would improve it. At the end of the day, what you got to think about is there's twofold. One is, as an investor, we have to think about that incremental yield or the spread we get for taking on the credit risk. That's what he's referring to when he talks about valuation being tight. Right? We look at high yield bonds. They're massively below average on their spread. I don't feel like we're in a below average risk world today, right? Which those two things usually coincide. But at the end of it, it's debt service as well. And so this has been the argument for the high yield bond market and the like, is that if rates come down, then essentially refinancing these coupons becomes more accretive and more helpful over time. So once again, you kind of have these dueling things, right? You're not getting compensated meaningfully for taking this incremental risk. But then at the end of the day, when you look at some of these companies, though, they're good quality names, right? And so even they may exist in the high yield bond market.
How much does this really complicate the discussion about U.S. exceptionalism and the loss and sort of the flow of funds elsewhere? I know that DoubleLine has been looking elsewhere, talking about how the U.S. is spending too much, not cutting financing, and also some of the trade policies. But you see also Europe spending. And today we see with the NATO meetings this commitment to 5% expenditure of GDP on military. Doesn't it sound like the same thing over there?
At least President Sun would say it's about time, right? That instead of us footing all the bills for NATO. Now, again, you're going to get different people on different sides of the aisle on that statement. But at the end of it, what you're talking about is this self-sustaining, is there exceptionalism? And one of the big benefits the U.S. has had over the last decade or so is that we have had the capital flight into our country. You know, people talk about this when you talk about emerging markets. The first thing you talk about is what's the FDI, the foreign direct investment. Well, the U.S. is a massive benefactor from foreign direct investment, right? Our stock market, our bond market, our trading partners, which helps essentially finance our deficits as well. So the big challenge with all of it is that if you're going to disrupt that, and I'll call it the orthodoxy, and that seems to me what Trump is doing, is that you're going to have downstream ramifications. Now, no one knows what it'll look like if investors pull capital. But I was concerned when we first started the tit-for-tat tariff that given the fact that we run such massive trade deficits with certain countries, we couldn't do a tit-for-tat. There's no way we could up our tariffs enough to really be punitive enough. So one thing that could happen the other way is that they could effectively say, we prohibit investing in the U.S. or incremental dollars should not. And you could see that from, let's say, sovereign wealth funds. You could see that from different governments around the world. So that's not off the table today. And look, we have 2 weeks till the self-imposed deadline on the tariffs, right? That we're going to have I don't know if they're called big, beautiful tariff deals, but we have that for the 2 weeks as a self-imposed deadline there. And thus far, we have one kind of puny, trade deal thus far is with the UK, and not much really occurred there. So baseline tariffs seem to be here to stay. That means costs of things will go up. It's just a question of is how much. Someone has to eat that cost along the supply chain, and effectively that will end up in consumers' hands at some point.
You've touched on some really important forces. I just want to go back to the beginning of those comments. Well, the president's message is to the rest of the world, we don't want your exports, but we want your capital.
Right.
What we've been asking is whether you can have one without the other. Do you think we can?
It's difficult, and that's what I'm saying. It's a disruption to orthodoxy, right? So historically, you haven't, and typically when you think through what happens with the trade deficit, is that well, if you're the exporting country, well, all of a sudden you're generating these dollars. Let's say in the case of for someone like Japan, who's ran a structural deficit for 4 decades, right? Well, they generate dollars. What do they do with those dollars? Well, they recycle them in the Treasury market. It brings stability to their currency. It helps them kind of manage the flow of that import-export business. So at the end of it, there is some disruption on the other side. And to me, that's the biggest wild card. But still, we don't know what the end game is on tariffs. We don't know what it ultimately looks like. They keep lauding the art of the deal, and this is all about negotiation. But what's the end game? And I think that's the thing that people have trouble seeing today. So it brings me back to what do you do? You don't trade it. You don't trade it. You don't try to get caught up in it. You know that there's more tariffs coming. The thing we're still concerned about is more sectoral tariffs, right? We've seen this with the steel and the aluminum. They're going to go after the pharmaceutical industry. They've been very vocal about that. So there's things that you can kind of try to avoid going forward. But at the end of it, centered at trade is our economy, right? And so at the end of it, it depends on what we look like in growth. And the growth variables are very noisy right now, right? Because of the front loading of all the import data in the first quarter, we gave it back in the second quarter. That's why you see this big jump in estimates for second quarter GDP. But is it really growth? It's really just the import-export mechanism. But thus far, and this comes back to your comments about Jay Powell, is that he's focused on the labor market right now, because right now he sees that the tariffs are going to have uncertainty. It's going to take 6 to 9 months to know what that looks like. So right now he continues to focus on the labor market, which has been surprisingly strong throughout this whole cycle. Thus, that puts the Fed on hold. And, I think that his baseline is no cuts this year, no matter what the rhetoric comes out of Waller or Bowman this week. And remember, we're going to get a new Fed chairperson next year. That's the big wild card. It's not what happens in this next 9 months.
Yep.
It's effectively who that person is, how much control the president has over that person say-so. And that, to me, is the biggest wild card for the bond market.
Hey, Jeff, it's good to catch up. Appreciate it. Could talk to you all morning. Jeff Sherman there of DoubleLine.